Welcome back to the deep dive. For anyone tracking the markets, you know the calendar flipping to 2026 is never a quiet affair. We're seeing this massive surge of new high yield products hitting the market, and they've shown up with a really clear disagreement on how money should be made.
It's a philosophical split,
Yeah,
really.
it's absolutely. So, our source for this deep dive is a new retail investor report. It's detailing all these major ETF and fund launches happening right at the close of 2025.
Mm.
And what it captures so well is this tension between two very different camps. You've got the NAV defenders on one side, all about safety.
And on the other, the yield chasers, who are much more aggressive.
Exactly.
And that tension is really the core of what we're looking at. Our mission today is, pretty straightforward. We're going to map out these two strategies. We need to understand the mechanisms, like how are they actually generating this income? And we'll pull out the most surprising details. We're talking clever tax solutions and, yes, some yields that are just astronomical. By the end of this, you'll have a really solid, informed view of this whole new landscape.
Okay, let's do it. Let's start with the NAV defenders. The report kind of paints them as the responsible party here, and the main issuer is Neos. Their whole thing is about NAV protection, net asset value, and making sure the distribution rates are actually sustainable.
Right, letting the underlying assets breathe, as the source puts it. They're trying to avoid paying you with your own money, basically.
Cannibalizing their own capital.
Exactly. And you can see that focus on capital preservation right away in the three new funds they just launched.
Okay, so the first one, this one really jumped out at me because it solves such a big pain point for investors. It's MLPI, the MLP and Energy Infrastructure High Income ETF. It's launching with a pretty substantial 15.56% distribution rate.
Yeah, the key thing here isn't just the yield. It's the brilliant structural fix they've applied. It makes a whole asset class suddenly accessible. Master limited partnerships, MLPs, these are the backbone of the energy sector.
The toll roads, right? Pipelines, storage facilities.
Exactly. They're traditionally great income generators.
But the headache has always been the tax side.
Oh, absolutely. Traditionally, if you owned an MLP, you got a K1 form at tax time. And these things are just a nightmare. They're complex, they're often late.
You practically need an accountant just for that one form.
You do. And so retail investors just stayed away. It turned a good investment into this thing you dreaded every year.
So, how does MLPI solve this and still deliver that kind of yield?
By putting it all inside an ETF wrapper, Neos completely sidesteps the K1 issue for the
For the end
for
investor.
the end investor, right? The ETS handles all that complicated K1 stuff internally, and you just get a standard 1099. That one change unlocks this entire asset class for millions of people. It's, genuinely useful financial innovation.
Okay, that's smart. Now, speaking of high yield and let's say more modern assets, we have to talk about NEHI, the Ethereum High Income Fund. This one has an incredible 34.60% annualized yield. 34%. If these guys are the defenders, how on earth can they sustain that on something as volatile as Ethereum?
That is the fundamental question. And it gets right to their strategy. I mean, 34% seems crazy high, but you have to look at it as a covered call strategy on a very volatile asset.
Mm.
Ethereum's volatility means they can sell options for these huge premiums. That's where the income comes from.
So the volatility itself is the engine for the yield.
It is. And what's also really interesting is the comparison the sources make to its sibling fund. That 34.60% for NEHI significantly outpaces their Bitcoin fund, BTCI.
Oh, what's BTCI at?
It's sitting at 27.07%. So this tells you that right now, the income potential from Ethereum's volatility is just much, much higher than Bitcoin's.
And they're capturing that difference.
They're capturing it aggressively, but still, with the goal of managing the principal.
Okay, so two high yield funds solving problems or monetizing volatility. But then there's the third launch, NLSI, the long short equity income ETF. It's clocking in at a much lower 5.51% yield. I mean, that almost looks boring next to the other two.
And that is precisely the point. This is where that NAV defender philosophy really comes through. This fund is designed to be a stabilizer for 2026. The strategy itself is super sophisticated. It's usually something reserved for hedge funds.
Can you just quickly map out what long short actually means in practice for someone who doesn't deal with that every day?
Absolutely. Think of it like a market neutral approach. They're going long, so they're betting on a bunch of stocks they think are undervalued, and at the same time, they're going short, betting against a different basket of stocks they think are overvalued and will fall.
So they're not just trying to ride the market up.
No, not at all. It comes from the premium generated by that balanced lower volatility position. It's really the ultimate defensive play for stability.
That makes a lot of sense. It's not about getting rich, it's about staying stable. So, if NEOS is our designated driver, now we have to talk about the ones the report calls the ones buying a rounds of shots, the yield chasers.
This is where we see the other end of the spectrum for sure. This group is Granite Shares, Defiance, and of course Yieldmax. Their whole goal is maximizing that dividend payout today, and they often accept, a lot more structural risks to do it.
And the numbers they're printing are, well, they're just shocking. Let's get right into it. Granite Shares, for example, their HMYY fund on Hims and Hers is yielding 178.90%.
It's incredible.
Their Riot Platforms Fund, RTYY, is at 179.31%. And RGYY for Rigetti Computing, 163.44%. You just can't ignore triple digit income.
You can't ignore it. But this is where we have to talk about the mechanism. Huge, because the risk is huge. That premium is what funds the 170% payout. But, and this is the critical warning from the sources, to maintain that payout, there's a very real risk of significant principal depreciation, NAV decay.
So the fund pays you a huge distribution, but the actual value of your share in the fund could be going down over time.
That's the trade off. You're swapping long term capital stability for massive immediate income.
So there it is. NEOS protects the NAV first, the yield chasers protect the payout first.
It's a zero-sum game between the two. Now, it is worth noting the sources found one, let's say, calmer exception in this group, Roundhill's UNHW, which is an option strategy on United Healthcare. It's at a much calmer 33.71%.
Which is still a massive yield.
It's huge, but because it's on a big defensive healthcare stock, it offers that income layer without the same, high wire act of the others. A slightly softer shot, let's say.
Okay, moving back to the aggressive side. Defiance is also in the mix with YBMN, yielding 56.54%. But I want to spend a minute on Yieldmax. They are just continuing their strategy of, well, sheer market saturation. They've launched this Target 25 series.
Yeah, funds like TEST, NVIT, MSST. And what's so interesting here is the precision of the strategy. They are explicitly targeting a strict 25% yield.
On stocks like Tesla, Nvidia, MicroStrategy.
Right. It's a marketing angle, aiming for that perfect round number that investors can latch onto.
So how are they doing? Is it working?
A sharp observation from the editor of the report who asks this very pointed question about, market saturation.
Right, the editor's question. Do we need 5 different ways to harvest yield from Tesla?
And that's a great question for the industry. I mean, if you already have multiple Yieldmax products on Tesla, does launching another one with a specific 25% target help? Or does it just confuse investors? The editor's mission is clear. They are watching TEST very closely to see if it can actually hold its NAV while hitting that 25% payout. It's the perfect litmus test for this whole philosophy.
Okay, that sets the stage perfectly for 2026. Let's shift to the pipeline for the new year. The report highlights some really anticipated moves, starting with what they call Amplify's HEC attack.
This one just makes a ton of sense. Amplify has filed for a covered call ETF based on their really successful cybersecurity ETF, HACK. HIC itself is a strong performer in a high growth sector. It's up, 7.65% year to date.
So why do a covered call strategy on a high growth fund like that?
It's all about monetizing volatility. You're marrying growth with income. The cybersecurity sector is high growth, but it's also prone to these rapid ups and downs, what we call market chop. So a covered call strategy holds the stock, in this case HACK, and sells the right for someone to buy it from you at a slightly higher, generating this reliable income from all that short-term chop. It's trying to give you the best of both worlds.
And the source material gets pretty excited about what this could mean for Amplify's other funds.
Oh yeah. If HACK gets one, the report immediately speculates about others. BLOK for blockchain, BOTT for batteries, and THNR, which is their weight loss drugs fund.
That one's been explosive.
For sure. And this is a really important trend for you, the listener, to watch. Product innovation is trying to solve this puzzle. How do you get exposure to these exciting high growth sectors, but also get the reliable monthly income that people need for cash flow? This planned HACK ETF is a perfect example of that.
All right, now for a bit around this, because of closed-end funds, CEFs.
That excitement was completely justified. Traditional CEFs have this really unique advantage: a discounted dividend reinvestment plan, or DRIP program.
Okay, what's so special about a CEF's D to I compared to just reinvesting dividends in a normal stock?
The magic...
Pounding your money at a discount?
Exactly. It's this drip at the NAV opportunity, and it's a huge boost for long-term growth. It's why savvy investors have always loved traditional CEFs.
And this is where the filing for the new ETF suggests things take a disappointing turn.
They certainly do. It looks like this new fund isn't a traditional CEF at all, but just a fund of funds that buys existing CEFs on the market.
What does that mean for the investor?
Well, for you, the listener, this difference is crucial. First, it probably loses the tax advantage here.
So it strips out the best part.
It strips out the most powerful compounding advantage, and that really dampened the enthusiasm for this one. It just proves the structure of the product matters just as much as what's inside it.
Okay, so to wrap up the new landscape, we'll give a quick nod to Defiance. They're still catering to the high risk day trader crowd. They're going 2x again.
That's right. The market for extreme leverage is still going strong. They've announced two new 2x leverage tickers, BTFL, which is 2x Bitfarms, and ONDL, 2x Ondas. These are clearly for short-term tactical plays, not for income investors.
Yeah.
But it just shows how wide the spectrum of new products really is.
So we've mapped the whole landscape. We've seen this really stark division. What's the final takeaway as we head into 2026?
Well, you've seen the two sides. The low yield, stable funds like NLSI that are all about protecting your principal for the long term. And you've seen the triple digit yield chasers like RTYY designed to maximize your immediate payout, maybe at the expense of that stability. Knowledge is most valuable when you can apply it, and hopefully this deep dive gives you the map to do that for your own portfolio.
Yeah, we see this clear split between funds focused on maximizing NAV protection and those focused on maximizing the dividend no matter what.
So given the massive yields we're seeing, RTYY at nearly 180% compared to the dedicated defense fund NLSI at a steady 5.51%, it raises a really important question for you to consider for 2026. Which is the more critical portfolio protection strategy right now? Is it chasing that monumental income, regardless of the risk to your principal? Or is it stabilizing against market volatility, even if it means a smaller distribution? That tension between the immediate payout and long-term sustainability is absolutely something worth mulling over.